Something really interesting is happening in the markets right now. A massive disconnect. You've got the stock market, which is acting like the party's just getting started, but then you have the prediction markets, and they're forecasting some serious storms on the horizon. So, which one is right? Let's get into it. Okay, but before we dive in, just the usual quick heads up. This is all for informational purposes. It is absolutely not investment advice, so please always chat with a qualified professional. All the analysis we're breaking down today comes straight from reflectionsofreality.substock.com, so the views are the original authors, and you know the drill, investing always involves risk.
So that brings us to the big question we're tackling today. With stocks soaring to new heights, is the market just completely ignoring some really clear warning signs that are being flagged elsewhere? Let's unpack the evidence and see what's going on.
First, let's start with the good news. Let's look at exactly why the market feels so optimistic right now. And honestly, there are some pretty powerful signals telling investors that it's all systems go. And what's really driving all this optimism? Well, it really comes down to this. The market is in what's known as a Goldilocks state. We're seeing an incredible 82.4% reading here. What that means is we've got solid economic growth happening with low inflation. And historically, that is the absolute best, the perfect environment for stocks. And it doesn't stop there. This next chart really hammers the point home. This is the medium-term risk indicator, and as you can see, the bull reading is firmly on at 58.9%. This confirms that traders have a really healthy appetite for risk, which is exactly the kind of momentum you want to see in a strong uptrend. And to top it all off, the big one, the Market Dashboard Index, is sitting pretty at 61.4. Now, this number puts us right in the bullish kickoff zone. For swing traders, this is basically the sweet spot, the best case scenario where historically the returns have been fantastic. So by pretty much every measure, the party is on. Okay, so everything looks great, right? Well, this is where we pivot. Because while the stock market is popping champagne, the prediction markets over on Polymarket, they are pricing in a totally different world, one that's full of some really serious market-moving risks. And this table just lays out the difference in black and white. Forget Goldilocks. Polymarket is worried about a much more aggressive Fed chair, major geopolitical conflicts, and big disruptions to our energy supply. And we're not talking about small bumps in the road here. These are things that could change the whole game. Let's focus on this first number, because it's a big one. Polymarket is giving it a 94.5% chance that Kevin Warsh becomes the next Fed chair. Now, Warsh is a well-known hawk. His confirmation would signal a huge shift to a tougher monetary policy. Think higher interest rates for longer. It would basically be the end of the easy money era that's been fueling this market rally. Then you've got the geopolitical stuff. A 30.5% chance of a U.S. invasion of Iran by 2027, that is nearly a 1 in 3 probability. An event like that would be a massive shock to the system. You'd almost certainly see oil and gold prices go through the roof, while riskier assets like stocks would get crushed. And hey, 7.4% might not sound like a huge number, but for an event like a potential China-Taiwan conflict, the source material calls this the largest unhedged tail risk out there. What that means is it's a low probability but absolutely catastrophic event that investors have basically no insurance against. A conflict there could completely shatter supply chains and could easily trigger a stock market crash of over 30%. And yet, the market seems to be sleeping on it. So this brings us to the heart of the matter. How do we square these two completely opposite stories? Where is this gap between the market's good mood and the reality of these future risks really coming from? Well, first, let's talk valuations. This index shows that even with all the bullishness, stocks are already a bit expensive compared to bonds. See that green line? That's the risk premium, and it's shrinking. In simple terms, that means there's less of a cushion, less of a safety net to absorb any shocks. The market has way less room for error. And if you peek under the hood of this rally, things get even more telling. The main thing happening with large cap stocks is rotation out of position, which is just a fancy way of saying people are taking profits. But look at this. Institutional buying, or accumulation, is incredibly weak at just 9.6%. The big money, the so-called smart money, they are not chasing this rally with any real conviction. All right, so given this massive divide, what's the play? How might you think about building a strategy that respects the bullish trend we're in, but also prepares for these very real, unpriced risks? The analysis based on Polymarket's data points towards something called a convergence strategy.
The whole idea is to position yourself for that gap between the market and reality to finally close. So the implied stance is to maybe sell equities into these rallies, expecting a tougher Fed and geopolitical trouble. At the same time, it suggests being long on things like oil and gold as a hedge, and long the US dollar as a safe place to be.
So, to break that down into some simple takeaways, for stocks, with those unhedged risks looming, it suggests maybe trimming positions when the market is up. For bonds, a hawkish Fed makes shorter duration exposure more attractive. Commodities like energy and precious metals could be your shield against geopolitical shocks. And finally, when things get scary, the US dollar usually benefits as everyone rushes to safety.
And you know what? We can actually see some of these moves happening in real time. This ETF rotation map shows money flowing into the energy sector. But what's interesting is we're also seeing people selling out of gold and silver ETFs. Now, that might just be some short-term profit-taking, but it really seems to contradict the long-term strategic need for these assets as a hedge, especially against the exact risks Polymarket is warning about.
So, after weighing the party happening in the stock market against these pretty sobering predictions, we're left with one final and, I think, critical thought. And this quote from the source material, Reflections of Reality, just nails it. The largest consensus gap is in geopolitical tail risk. Polymarket prices it, yet equity vol and oil options remain cheap. In other words, Polymarket is screaming a warning, but the insurance policies in the stock and oil markets are still surprisingly cheap. People just aren't buying protection.
Which leaves us all with this one last question to think about. History shows us over and over again that complacency can be one of the most expensive mistakes an investor can make. With the gap between the market's mood and the actual risks getting wider every day, the real question is, are you prepared to pay that price? Thanks for tuning in.